Principles of internal control. Internal control varies from company to company because of the nature and size of the business. However, certain fundamental internal control principles apply to all companies. The principles of internal control are to establish responsibilities, maintain adequate records, insure assets and bond key employees, separate record keeping from custody of assets, divide responsibility for related transactions, apply technological controls, and perform regular and independent reviews. So we'll take a look at each of those individually. First, I'm going to give you a mnemonic to remember all of these. So remember in elementary school, you learned about PEMDAS when you were learning like the order of operations. So for this, just remember PEMDAS, and that helps you to remember each of these. You don't have to know them in a specific order or anything like that. This is just to help you remember what the principles actually are. So I'm going to go through them in this order. I for insure assets and bond key employees. So assets should be insured against losses. So this means like an insurance policy. And employees handling lots of cash and easily transferable assets should also be bonded. An employee is bonded when a company purchases an insurance policy, also called a bond, against theft by that employee. Bonding discourages theft because bonded employees know the bonding company will pursue reported theft and they'll get in trouble, get fired. P for perform regular and independent reviews. Regular reviews of internal controls help to ensure that procedures and rules and regulations are followed. These reviews are preferably done by auditors not directly involved in the activities. Auditors evaluate the efficiency and effectiveness of internal controls, but remember that management of the company is responsible for putting those internal controls in place and regularly monitoring and testing them. So to take that one step further, an auditor comes in and performs an independent review of those controls. So many companies pay for audits by independent auditors. These auditors test the company's financial records and evaluate the effectiveness of internal controls. E for establish responsibilities. Responsibility for a task should be clearly established and assigned to one specific person. When a problem occurs in a company where responsibility is not established, determining who is at fault is difficult if it's not assigned to one specific person. So, for example, if two sales clerks share the same cash register and cash goes missing, neither clerk can be held accountable because you did not separate that effectively and efficiently. So, to prevent this from happening, a company can use separate cash drawers for each cashier. M for maintain adequate records. Good record keeping helps protect assets and helps managers to monitor company activities. When there are detailed records of equipment, for example, items are unlikely to be lost or stolen without detection. Also, transactions are less likely to be entered in wrong accounts if a chart of accounts is used. So that helps with record keeping, having an actual record, a chart of accounts. Other types of records are pre-printed forms. Those are a good part of internal control. So that makes sure that everything that's needed on a form, there's like a blank for it. So all the necessary information can be collected on a form. When sales slips are properly designed, employees can record information efficiently with fewer errors. When sales slips are pre-numbered, each slip is the responsibility of one salesperson, preventing the salesperson from stealing cash by making a sale and destroying the sales slips. So having pre-numbered forms. Maybe you've seen your parents' checkbook I would think your parents still have checkbooks. I have one because I have to write a check here and there occasionally for like my son's school, sports, and stuff like that. But a checkbook is an example of something that is pre-numbered. And that's how you can keep track of each individual check because they have a number on them. And then computerized point of sale systems achieve the same types of control results. So essentially, having a computerized cash register like everyone has now, where you scan the barcode beep, having one of those types of point of sale systems is going to have more control than just a calculator or a cash register that just like calculates. So those are some types of adequate records. D for dividing responsibility for related transactions. This is one that we'll talk about a lot. So responsibility for a transaction should be divided between two or more individuals or departments. You don't want one person doing everything for a transaction. So you don't want one person being responsible for making the sale, taking the cash, recording the cash, and then also be responsible for taking the cash deposit to the bank. That's too much responsibility for one person. They could easily get away with skimming some of that cash or not recording the sale properly. So, basically, dividing the responsibility for a transaction between two or more individuals ensures the work of one person acts as a check on the other. So, checks and balances to prevent fraud and errors. This principle is called separation of duties. You'll also hear it called segregation of duties. It means the same thing. But basically, that means that you're not duplicating work, you're not making extra work. You're taking the same amount of work and dividing it between individuals so that there is less possibility for someone to make a mistake or to purposely steal. So, for example, one employee would submit a request to buy inventory. A second employee would approve that request. Third employee would be the one to make the payment. And a fourth employee would record the transaction. So it has to go through multiple steps for one process. A for applying technological controls. Cash registers, time clocks, ID scanners, these are all examples of devices that can improve internal control. So anytime you can computerize something or have like a password protected file, encrypting documents, these are all types of technological controls that you can put in place. S for separate record keeping from custody of assets. This is very similar to what we talked about in terms of separation of duties. So the person who collects or has access to the asset, for example, money, inventory, things that can be easily stolen. So the person who has access to those must not also have access to the assets records. That's really hard to say. So if one person has physical access to the cash and is also responsible for recording that cash, it's very possible that they might not record all of it, and some of it might accidentally happen to end up in their pocket. So having one person with control over the cash and another person responsible for entering it and responsible for the accounting records, that reduces the risk of theft or waste of an asset because the person who has control over it knows that another person will be the one checking and making sure that it's recorded correctly in the records. So, vice versa, the person who keeps the records cannot also have access to the asset because then that would allow them to falsify the records and just as similarly end up with some of that either cash or inventory walking out the door with them. So that means that in order for someone to successfully steal something, they would have to hide the theft from the records, or two or more people would have to collude, so work together. So you could have the person who has access to the cash, you've got a control in place where they're not also recording it. But if those two people collude or work together to commit fraud, then they could work as a team to steal the asset and improperly record it so that there would be less likelihood of that being found out by the company. So we can put all these internal controls in place, but there are still going to be limitations to those. The two primary limitations, first of all, human error. We are human, we are going to make errors. That's one thing. Another thing is human fraud. So intentionally entering things incorrectly. So that's the human element of it. The other limitation is the cost benefit principle. So essentially, you have to weigh the cost versus the benefit of a type of internal control. So if you can't justify the cost, like if it costs way too much to implement an internal control, then obviously that's not going to be worth it. So analysis of cost and benefits have to consider all the factors, including impact on morale. Most companies have a legal right to read employees' emails, yet companies rarely do unless there's evidence of potential harm to the company. So all of that relates to the cost benefit principle.